Okay, let's do a little bit of a market update for you. So, just in case you don't already realize it, the financial markets are a manipulated liquidity scheme by the Federal Reserve System of the United States. And right now, the Federal Reserve little debt system that the United States set up 100 years ago is making the liquidity of the dollar decrease, which is making credit more difficult to obtain, and this is why you're going to see the unemployment rate start to rise. Um, you can see this reflected in the dollar index, which has gone through a massive super spike over the past year and a half, 2 years, which this is a lot for an entire currency to be moving this much. So this is very significant, and this is because the United States Federal Reserve has made the dollar more desirable because they are increasing the interest payment obligations of using dollars to transact. So it's kind of hard to understand, but you got to realize that the most of the dollars in circulation were just created out of thin air by the fractional reserve banking system. So think about it, the fractional reserve banking system doesn't have to have really any money in its system to really perpetrate new money. If you think about it, so someone goes in and puts $100 in the bank. Well, the bank is going to then turn around and lend 90% of that out because we live in fractional reserve banking. They're going to lend 90% of that money out and only keep $10 in the bank for this guy, because most people leave all their money in the bank. So the fractional reserve system is strategically lending out your money. Most of the banks, if most of the banks in the U.S., if 10 to 15% of any given population within a bank in the United States, if just 10 to 15% of the population went to withdraw their money, the bank would be insolvent. Why is that? So 10 to 15%, that's not really that much. So if bank run happens, it only would take about 10% of the population to say, all right, I'm taking all of my money out of the bank. And the bank would be insolvent and fail because of this thing right here. They take 90% of your money, they lend it out to someone else, some other bank, and everything gets fractionalized. Then that bank gets your 90%, so say that's $90. Over here at Bank B, this is Bank A right here, they'll take your $90 and they'll say, all right, well, our reserve ratio in terms of how much money we need to have in the system is not that high, so we're just going to keep 10 because we don't think we need that much in our banking system, and we're going to loan out another $80 of this. Sorry about the writing, it's kind of hard to write on TradingView, but so we're gonna create 80 more dollars out of this, and you can see from the original 100 that was created, we created another 90 and another $80 in the fractional reserve system. And obviously here you have more than the 100 you started out with. So this kind of demonstrates how the fractional reserve banking system works. They just create money out of thin air because they're allowed to have a reserve ratio that's like, 10 or about 70% of value. So if the bank has $1,000 in the bank, they only are required to keep 300 of it, and they can make loans and loan out the rest of your money. So what I'm saying is there's not actually enough dollars in the system to meet the obligations of the creditors, okay? And that's why you're seeing the dollar spike up, because the demand for the dollar is increasing while we fractionalize the amount of actual dollars in the system to the upteenth degree. Because this will just go on to Bank C, and then Bank D, E, F, G, H, I. It'll keep happening. So the banking system, the private banking system, is responsible, for the creation of all this paper, digital money that doesn't really exist. Like I was saying before, if 10 to 15% of the population decided, I want to withdraw every single thing from my bank account, the bank would be insolvent because they don't actually keep that money on hand. They fractionalize it and send it to other banks. Now, the Federal Reserve right now is making the credit of the U.S. dollar more and more expensive with interest rates. It's one of the policy tools they use. And right now, that's creating a strong demand for the dollar. So that was a little bit of macro before we get into the rest of the charts, but I just want you to be aware that the Federal Reserve is a private banking system that has criminalized the use of the dollar, and they do shady tactics like this all damn day, and they have for the past decades. So it's a real fucking farce out there, people. Already in China and Australia, you're having bank runs, but they're freezing the ATM withdrawals. Wonder why? Well, it's because they're only required to keep a certain percentage of reserves at the actual bank. The rest is just funny money, paper money that they made up for fun. So they can, they can make money on loans and all sorts of other stupid shit. All sorts of all other dumb regulatory stuff that banks can do that you and I can't. That's like me saying, that's like when Sam Bankman-Fried said, "Oh, you just deposit your money here on FTX, and we'll everything's backed." But in reality, none of it was backed, or it was partially backed by FTX tokens, which are just like complete bullshit. What I'm saying is the central banking system, the private banks around the world are doing the same exact thing. They're just allowed to do it because they created a legal framework to run their fucking Ponzi scheme like 100 years ago. You know what I'm saying? Like, they have the proper regulatory commission body framework, blah, 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 to run their stupid scam. But it's a scam nonetheless. So let's look at some volatility products, because I think volatility is really important to look at right now, because I think volatility is going to be continuing to go up. As you can see right here, the past couple days, we've had a spike in volatility. Really the past week. 22% volatility is up, and as you can see, during these portions of time where we had these reversals on the volatility, like basically here, and here, with volatility around 20, you can see as soon as that happened, the inverse happened with the stock market. So there was that first time the VIX hit 20, went up, and your stock market went down. There's a second time, went down. And here's your third time. So it's pretty obvious what's happening to me. Things are going to get volatile again. Market's going risk off. Partially because the United States is in the middle of tightening its liquidity, which means the amount of funny money dollars in the system is it's basically going down because they're shrinking the balance sheet. They're saying, we can't have as much fake money on the balance sheets of these central banks. We need a little less fake money. And what's going to happen is because of the proliferation of bad debt and the proliferation of high interest rates, there's these companies around the world aren't going to be able to meet their debt obligations probably next year. And then that's when we'll enter the big reset, finance, Armageddon part 7, or whatever the fucking part is, since they crash the markets every single fucking 5 years or so, 5-7 years. Anyways, we had our channel oscillator right here flip green, so that's great news if you're shorting. Bad news if you just entered longs. Yeah, sorry if you got tricked into that Santa Claus rally, but it doesn't look like it's happening here. Obviously, we're smoothing out here. This is looking a little more calmer. Maybe this will come up here. Ultimately, I think it's going to keep going downwards, though, whatever direction it decides to take, whether it be that way, this way, this way. I think that was the end of the rally, and we're going risk off for the remainder of the year and into 2023, because how else would they do their currency reset without crashing the economy first? Guys, come on. They want to get that surveillance finance with the central bank digital currencies in. They got to crash the economy first. Come on. It's part of the plan. Okay, so VVIX, which is the volatility of the volatility index. You can see we're making higher lows here. We're going up this way. Up 10%. So, as you can see last time, we know what happened. And then here's the 9-day VIX, which is an even shorter calculation of when the volatility is. This is 9 days out. The regular VIX is 30 days out, which is funny. I didn't really know that until recently. If you're a stock trader, helpful hint there. There's different volatility products you can look at. Anyways, we've had the 9-day volatility just do a huge fucking run up. And now we have support from our EMA band. We're above the 200 week. We've tagged green on our channel oscillator. So we're all set to go for equities to take a big old shit, in my opinion. As you can see, we've had the channel oscillator flip red here. We're still sitting on some support from this EMA ribbon, but as you can see, this was a rising wedge pattern right here with the Dow. So, you know, I expect maybe a retest and fail, and then you'll have a head and shoulders, or you'll just keep going down. I don't know exactly what will happen, but balance of probabilities says that the Santa Claus rally is over. All right, and here's the S Dow. This is the short Dow. As you can see, we moved up. Our channel oscillator has not flipped green here. A lot of times it doesn't do that when prices are so iffy on the edge. So the value of the short hasn't really turned around, but as you can see, we've made a nice bullish fractal right here. We might fall on our face. We could fall on our face here, but ultimately I think we would head further up, and then you'd have an inverse head and shoulders right there if that were to happen, or you could just gain strength and go this way, or you could fall back down. You know, I really think we're risk off though, so I would expect a continuation in the short. Let's look at the NASDAQ, looking even weaker. You can see our channel oscillator already tagged red here, and then you're sitting on top of your 200 week support. If you lose your 200 week here, for anyone in the tech sector, if you lose your 200 weeks as support right here, that is bad news. Very bad news. As you can see, if we get rid of some of this other stuff so you can see a little bit more clearly, you got this green line right here. That's your 50-day moving average. And right now you're getting support from your 50-day moving average and your 200 week moving average, but as you can see, you got resistance from the 100, and you got a lot of overhead resistance right here from your 200. As you can see, NASDAQ all throughout the year hit its head on this 200. You could potentially see a pop right here, and maybe it goes up here and then goes down, or maybe you just fail right here, or you do, you know, you might bounce around in here. Ultimately, what I'm saying is if you lose these levels down here, not good. If you can gain support and get above this 100 right here, you're still probably going to hit your head on this 200 and fall on your face. So I really wouldn't be longing right now. I would be maybe looking for an opportunity to short, or, you know, find a stock that is going to be doing well regardless. Like if we go look at where did you go? So here's Eli Lilly. I believe that they're pharmaceuticals. As you can see, this is still in a bull market. So there's still equities that you could buy right now that are still going to be doing well. Like here's McDonald's. You know, not terrible here. You're still technically in an uptrend in a bull market. Here's Pepsi, still kind of in an uptrend. So Wells Fargo, a bank. I wouldn't be buying this. You just had a bull cross right here, but it'll turn into a death cross here like very shortly because you're below it right now. Anyways, you know, stay away from banks. Stay away from any company with a high debt to asset ratio. Maybe buy something like this, which I'm sure they have government contracts. Speaking of government contracts, here's Northrop Grumman. I mean, these guys make all sorts of technology for the military. You think the military is going to stop wasting taxpayers' money during an economic downturn? I think fucking not, friend. So as you can see, the performance of this stock has just been fucking off the charts. It did take big hits in the .com and the 08 crash, so I mean, there's a potential that it could still get its socks knocked off here if we're going to have a global financial crisis. But, you know, in general, this has been doing way better than the rest of the broad market this entire year. And you'd be hard-pressed to find a lot of stocks like that. Here you can see part of the ARK Invest's profile. Actually, we'll go up to... I made a whole section for ARK Invest. A bunch of dumb stocks. A bunch of meme stocks. So here's Tesla. Finding support on its 200-week moving average. Definitely still in a bear market right here. You know, maybe you see a rally up to this, but it's been resistance here. I wouldn't be surprised if it was resistance again. Maybe you'll get some kind of pump up, and then you get rejected off this 200 again. who knows? But like the rest, if you lose your 200 right here, boop, it is a slippery slope downwards if you lose your 200, because that's like really, really, really bear market territory. I mean, you've already had a death cross right here, so you're in a bear market. But if you drop below this, I mean, you're really in a bear market. And look how thin the structure is right here. I mean, you'd just be visiting each and every level. I don't know how long the financial reset crisis is going to be, but, Tesla's sitting pretty precarious right here. If you can't get back up into a bull market, pretty scary. Here's ARK Invest. Now, you actually could see a pop from this, because if you look, this 50-day is getting really close to where the price is moving. If the price can get above this 50-day and then use it as support, and then you might pump into your 100 or your 200, but ultimately get rejected again because you're way below your 200-week moving average on this stinker. So would not be looking to long the tech sector right now. And if we look at a couple other companies in the ARK ETF, we'll look at a couple of holdings. So Zoom, I think, is about 5% of ARK. You can see Zoom's done a complete round trip all the way back to where it was. I don't know how old Zoom is, but this is as far back as my chart goes, about middle of 19. As you can see, we've made a complete round trip back to those levels. I don't expect this to do anything, because this just looks like a head and shoulders. Shoulder, head. So, that's a stinker. Exact Sciences, you can see Exact Sciences just had a pump up to its 200-day moving average on probably some sort of fundamental news or something. But this would be a great place to short it, in my opinion, because you got your RSI way overextended up there. And if we change the MACD interval to the daily, I'm sure that's way up there high too. We need to make this bigger so you guys can see what I'm talking about. Yeah, so your MACD is pretty extended. If this green line gets back below this blue line, you have negative divergence. And you have negative divergence on your RSI right here too. So you have this going down while price is slightly going up. That's negative divergence. I would expect this to do something like that and go back down this way maybe. Yeah, so another stinker inside the ARK portfolio. Don't know why she's buying all this dumb shit. Look, here's another thing she fucking bought, and by her I mean Kathy Woods. She's the lady that manages ARK Invest. I think she should be fired at this point though, because look, she's like, oh, we'll just buy the dip. We'll just buy the dip on all of my high conviction plays. It'll pay out. Well, she just bought a shitload of Coinbase, and that's been going this way, as you can see. Down from 427 to 44. What's that, like 90% of its value? Yeah, 90% of its value, and she thinks now's a good time to buy right before the Fed pivots. Hope that works out for you, Karen Woods. Don't think so. Oh, and here's another one in Kathy's profile. Roku, that looks real healthy and strong. That's only been going that way for like a whole 525 days. I'm sure it'll change the trend real quickly here as the Fed pivots. Obviously sarcasm. Here's Square, another stinker. I'm sure this will be, I'm not sure, nothing is sure, this is all probabilities, but as you can see here, looking pretty obvious to me. We got your standard dick and balls chart right here. So that's kind of what I think of Kathy Woods' ARK ETF. On the other hand, the S-ARK, short ARK, that seems to actually be in a bull market right now. Interesting. I wonder why. It's probably because her portfolio is full of fucking stinkers. Anyways, this is just, happily bouncing along its 200. I expect it to keep doing that until it gets squeezed in between these 2 points right here. And then eventually, once this has enough volatility squeezing going on within this triangle, you're either going to fail or you're going to pop up and you're going to rally even more, probably up to this level, or this level, because you're in a volatility funnel right here, and everything that the ARK tracks, all of its holdings, are going basically straight down. Like here's Robinhood. It's been going kind of sideways, consolidating, but as you can see, it's still below resistance. So this is not good. This is not a bullish chart pattern. I would expect something like that. overall to occur along with the rest of Kathy's profile. So yes, I am short ARK because they're high beta and they buy fucking stuff like Roblox and put it in their account. Come on, are you 5 years old, Kathy Woods? It go this way, down, down, down. I don't know why she thinks that's going to be over anytime soon. The Fed hasn't even pivoted yet. They haven't even introduced their central bank surveillance finance. Kathy, they're not even done with their plan yet, bro. They still got to fucking stamp on your rights more. Why do you think these companies are going to go up? I don't know. What are we at? We're at 20 minutes. All right, I've probably babbled long enough. Anyways, short the tech sector. If you can find a stock like Northrop Grumman where they get a bunch of government money continuously, go ahead. Maybe that's your equity that you want to be in. So peace out.